Greetings, I am Dean Jones, President and CEO of Realogic, Sotheby's International Realty, and this is Market Perspectives. We are so excited to have Carese Busby with Movement Mortgage here today. How are we doing?
Good. Thanks for having me.
It's been good to see you. We've been very active lately.
Yes, we have been. Yes.
Our story goes back like 20 years, Carese.
I know it does. I can't believe time flies.
What a difference a couple decades make. You know, a lot of people don't know that before you became an icon of lending, that you were doing a different kind of spinning around.
Yes,
on thin ice.
Yeah, I grew up as a competitive figure skater, local girl, and competed at the national level as a figure skater. My claim to fame is the Tanya Harding, Nancy Kerrigan Nationals.
But you didn't have anything in your hands,
no,
right? That wasn't you.
I didn't. It was not me. It was not me. But
wow.
It was crazy. Yes.
Well, what a tremendous event that was. And I think that was a pretty well-viewed episode of the Olympics, wasn't it?
It was. It caught the media because it was the first massive event that ever happened really in figure skating. And that year they had more viewers for the U.S. National Championships than the Super Bowl.
Wow.
Which is, Super Bowl, as we know, is just people around the world watch it. So to get that kind of viewership, it was a little intimidating to step on the ice and see the media 4 deep versus usually being 1 deep.
Oh, wow.
Yes.
Well, you know, I'm thinking of you spinning around and around and around on ice, and now I'm thinking about all the conversations you're probably having with borrowers.
Yes.
You know, speaking of major events, I mean, what is this Fed doing to us?
Well, I think that they are just really trying to, they're trying to make the right call. They're really trying to engineer what they call a soft landing,
all right,
which is hard to do. It's really hard to do.
You've had some hard landings in your time.
There's been some, definitely. And fortunately, it prepared me for this business.
Yeah, okay,
absolutely, it did.
You skinned your knee, you're okay.
I skinned my knee, I hit my chin, yes,
oh, wow.
for sure. But I think that the Fed is trying to engineer the soft landing. It's a tough thing to do, but inflation is just, it's the root of all evil in interest rates.
Well, where are we at with that? I mean, give us kind of a year-over-year perspective. Are we got it in check now or what?
Well, I think it seems that we're going in the right direction. The challenge right now is unemployment is really, really low and wages have been pushing up. And that's kind of a vicious cycle because wages going up are inflationary. And the challenge with that is when unemployment's so low, companies have to pay more to get those employees. So it just keeps going round and round. Based on what the Fed talked about a couple days ago, there are signs that we're moving in the right direction, but they've pushed back their forecast of being able to cut rates to where they think instead of being, second quarter like was the thought last fall, it's going to be more like summer, maybe even push till back of the third quarter, beginning of the fourth quarter. They really want to hit that mark of 2% inflation.
Well, I tell you, it's if it's not one thing, it's another thing. Here we thought we were. I mean, what these rates have like nearly tripled since the heyday, but that probably wasn't sustainable.
Right.
And do you ever think we're going to see sub 3 or 4% interest rates again?
I don't think we'll see sub 3.
Yeah.
I think it's possible we could at some point hit the 4s.
Right.
But it's likely over the next few years that we could get back into, I think, the 5s, like mid 5s. And that would be great. But can you imagine, Dean, look at how competition's already heating up this spring.
Right.
And rates are at 7. Imagine what's going to happen when rates come down to 6.
I think there's a bunch of pent-up buyers that are probably talking to you. I know loan originations are up, and with great respect, I understand it's been a tough couple of years, right? I mean, the number of professionals in your industry have depleted by half or more. Because there just is not a lot of refi going on, and there hasn't been a lot of sales volumes. I mean, we've had historically low volumes across the U.S. But does that mean that people don't want to buy or sell, Carese? Or does it mean they're all waiting for someone to, ring the bell?
Well, I think it's a combination. It really is about education right now with buyers. I think that cannot be, it cannot be overstated how important that is. It's educating buyers to realize that what will happen right now, in my opinion, is probably the single best time for a home buyer to get into the market and get on the ladder of home ownership. And the reason why I say that, especially to first-time home buyers, because right now, look at the condos. Condos are an incredible opportunity. There's
Yeah,
never
well below replacement cost. Yeah,
I don't remember a better opportunity. If we go back to the early
I do.
2000s.
I remember one. 2009,
Yes.
2010,
Yes.
and 2011. There was a brief
Yes.
moment, and you were active then, and you know, I'm not going to say it was your fault, Carese, but the mortgage industry in itself was providing credit to everybody that could fog a mirror. And, you know, you are talking to taxi drivers, a noble profession, but they have already had options on 3 condominiums. And, you know, at the end of the day, that wasn't a true read of the demand, was it? So
No.
developers overbuilt,
Yes.
and we got into a lot of short sales, and we had to work our way out. And at the exact same time, you know, the feds took away the lending vehicles. I mean, remember, we didn't know what the guidelines were going to be for underwriting. And so we went through a number of years trying to figure out who was going to buy these homes. So the prices dropped. And then, of course, what goes down went back up.
Yeah.
And we had a dearth of deliveries for quite a while. And, you know, by 2015, 5 or 6 years later, you know, people that bought back at the bottom, buy the dip, you know, we're pretty darn glad they did so.
Yes.
And I think we're there too again right now.
Oh, I agree. In fact, I've said to buyers, if you could have bought in 2009, would you, now looking back, do you wish you would have bought in 2009?
Right.
And every one of them says, yes, of course. I said, well, that's because you saw what happened.
Right.
Right now is your 2009.
It is.
If you get in and buy now, you're going to get in at the best pricing that you're going to see. Who cares what the rate is?
I'm so glad you said that.
Yeah, you're not tracking
Just
the rate.
refinance that
Yes.
thing, but you're not going to get that strike price again, that's for sure.
Yeah.
How about underwriting? I mean, is it more difficult to qualify now? Because, I mean, especially with like credit card debt, I mean, let's face it, those are probably jacked up to 20-25% now.
Yes.
I mean, what is your advice for someone that says, okay, Carese, this is the year, 2024, I am also worried about all those renters coming out of those buildings and going into home ownership. You know, we have a supply issue. It's going to get more competitive, and the more rates drop, the more buyers will come onto the field. So what is your advice to someone that's hearing this and saying, I guess we should start getting our credit cleaned up and contact a mortgage lender like you and what? Go through what process?
Yes, it is never been more important who you work with. Work with a full service real estate advisor and a mortgage advisor, not an order taker.
Okay.
Because it's important to prep. And the reason why is credit card debt is at its highest levels ever recorded in this country.
Oh boy.
So it takes planning. So if somebody wants to jump in the market, they want to contact a professional lender right away, because it may take some planning. And we can go ahead and look at the overall picture and make recommendations where they can go on a plan for, say, 3 to 6 months to get that credit cleaned up. There's things we can tell them that they can do to help them get the credit cards paid off, get them cleaned up, see where they're at, so that we see where we need to go and what needs to be done so that they can accomplish their goal of becoming that homeowner.
Let me ask you this. So we're going to need a mortgage. And we're competing against folks that are running around with all cash.
Yes.
What's your advice, or is there a way for you to do a bridge loan or something to help a qualified buyer that needs a mortgage on a home, but they need to close with cash? Otherwise, they're not going to win a multiple offer. What's your advice?
Well, cash is always a challenge to go
I mean,
up
I'd like
against.
to have all cash too, but
I think
I don't.
a lot of it is, if you're working with a really good lender, that lender is going to be able to have a conversation with the listing agent and explain why you are equally as competitive as that cash offer that they have. And the things that we do to set our buyers up for success to compete against that is we get them fully pre-underwritten. That means they're fully vetted. There's no road bumps. We're not going to have any surprises on the back end.
Okay.
So they can close the quickest possible amount of time. Generally, we can close that gap pretty close to where cash would within a couple days. They can also waive the contingencies they need to waive. They can release the earnest money. They can absolutely put their best foot forward so that when we tell that listing agent, look, this buyer is rock solid and as good as cash to get into that house. And also, I personally like to remind the agent, likely when they bought their first home, they financed. So this is how giving this person that shot gets them on that ladder to home ownership and helps them. And so maybe consider giving that borrower that
Yeah.
shot, because if somebody wouldn't have given them that shot to become a homeowner, even though they were financing, where would they be? We know the true way people get ahead in this country is through homeownership.
I mean, real estate's still made more wealth
Yes.
than any of the other, securities out there. I mean, I wonder where it's at with these tech stocks. And, I'm thinking about RSUs. I mean, there's a lot of would-be buyers that are packed into these apartment buildings paying $4 or $5 per square foot per month. And, they're getting on in their late 20s or 30s. And I know that home ownership levels have been, decreasing. We're in a city of more renters than owners. We know that the millennials are taking longer to couple up and to buy and to have children. And some just won't do any of those things. They'll just perpetually rent and move around and migrate. So, but, you gotta look at where their wealth is currently with restricted stock units. These tech stocks have been peaking at value. What kind of underwriting will you do? And do I have to sell a bunch of stock in order to get a down payment? Or what do you do? Because, this Washington State capital gains tax isn't very friendly. If it's over $250,000 of stock sale, you're paying, 7%, right? Unless it gets repealed in November.
Yes.
So what do you tell Mr. Amazon that wants to buy a home and they're sitting on a bunch of tech stock?
Yeah. They do not have to put 20% down. And that is still the most misunderstood, I would say, misconception that's out there in the market. People think they have to put 20% down.
Oh, so don't liquidate then.
Do not liquidate. No, go in with 5% or 10%. Here's why. We live in an area where we have great appreciation. I mean, what are we expecting this year? 5-6% probably on the average?
Yeah, it's going to range between, 50 basis points, 100 basis points per month, depending on the product type and, the market, but it's going up.
So let's say you have somebody that wants to get into an entry-level condo at $600,000.
Okay.
And they go in at 5%. Yes, they're going to pay private mortgage insurance, which in my opinion has been one of the greatest vehicles that have helped people into homes. It's unfortunately gotten a bad rap, but here's why. If you put 5% down on a $600,000 home, your PMI is probably about $220 a month. Let's say you're thinking of doing that or waiting out the market for 3 years to try to get to that 20% down. Now that home you could have bought at $600,000 in 3 years is now worth $672,000. So you would have lost out on $72,000 of equity to pay $7,900 in PMI. I'd much rather pay $7,900 in private mortgage insurance to get $72,000 in equity on a house.
And if they were going to liquidate another 10%, of that value from their stock portfolio, I mean, this tech stock might go up quicker than, the mortgage interest rate.
Yes.
So I think that that's just leverage, and that makes perfect sense.
Yeah.
Is it a higher interest rate when you put little down like that?
No, actually, no. That's the other thing that's misunderstood. No, you do not pay a higher interest rate with less down at all.
Well, I mean, maybe the only better loan I could come up with is, when is Movement Mortgage coming out with a no down, no interest, and you don't have to pay it back?
Well, that would violate the Ability to Repay Act. It probably wouldn't.
But you could have a lot of fun for
Yes,
about,
you
3
could.
weeks?
You could.
And then off to Mexico.
Yeah. I'm a proponent, though, of people always keeping their money moving. If you put a massive down payment into a house, I mean, look, it's great. You have equity, but it's dead equity because it's stopped moving. If you have money, put your down payment in, save your money, go invest it into, whatever investment's going to be right for you. Heck, a high yield savings account right now is yielding 5.5%.
Incredible.
The S&P, certain ETF funds in the S&P returned 26% last year. If you're making money, put 5% down, go live in that house, keep your money, invest it, save it for the next property you want to buy. That's really, I think, how you get ahead.
Well, let's talk about, if you have a nice equity position in your home, and before I ask this question, I mean, what is your sense of the quality of buyers that we have right now in our current housing stock? I mean, we had a correction in housing, but are we seeing any bank-owned real estate, REO, short sales?
Short sales are really low. Foreclosures are really low. You have to qualify. As a buyer, you have to really qualify. There's no more of this smoke and mirrors like what we had back in the day before the financial crash. No, it is thoroughly vetted. These files are, they go through several QCs before closing. They go through audits after closing. These borrowers, in order to qualify, they have to be rock
So we're
solid.
looking around, and all that real estate you see is probably owned by a qualified owner that has a nice equity position, and there's no real risk of getting some bargain basement deal because someone's going to lose it to the bank. So we're not going to see that this round.
I don't see it. I don't see it.
And we're seeing median home prices rising again, so it feels like that inflection point has already passed us by, and as rates come down, there'll be more buyers. And let's talk about investment. Now, I understand in your family you've had a portfolio of real estate that you're now managing. I mean, share with our audience kind of what's going on with generational wealth transfer, and some folks that might find themselves either making investments into income properties or managing that, and just from your own personal perspective, because I think there's a lot of folks out there that could see opportunities to make investments right now, but maybe haven't done that.
Yeah, there's a lot of opportunity out there in various different markets. You really have to look at what's that cap rate, what is the cost of the property, the mortgage payment on it versus the kind of rent that you can rent it out for to cash flow. But the cool thing about rental properties and investment properties is you make money two ways. One, you've always got the principal, which is the property. So that continues to appreciate. So you've got that appreciation going for you, plus you've got the cash flow coming off of the property. And as you pay that mortgage down every single month, the renter is essentially paying for the property. So as you start doing it, it's a long-term play. I'm not a fan of the flipping. I don't think that it depends. If there are people that are really good at it and they know how to do the math because they know what their entry point has to be and they know what their exit point has to be. It's hard to navigate that in a market. I look at real estate as a long-term play. And the reason why I say that is over time, we know that if you buy an investment property and you put a renter in there, that the property is going to continue to appreciate. You do need to keep up with all the maintenance on it. And that renter is going to help you own more of that house until ultimately it's paid off. And if you've done it right, when you're in retirement, now you've got a cash flow on a passive investment. Yes, again, you do have to keep the maintenance on it, but you can have a property manager help you with it, so you don't have to actively deal with all of the landlord and those types of situations that come up. But yeah, overall, it's an incredible way to build wealth and diversify wealth, because when we get into these markets where high inflation, it's a hedge. It's a way to diversify your portfolio so you're not totally in the stock market. You never want to be just in one thing. And it's a hedge. That's what a lot of people don't know, is that real estate is a hedge in an inflationary
And break
market.
down for us what changes have happened of recent with tax benefits of homeownership. Some of our first-time buyers out there, might only remember their older brothers and sisters talking about the last correction and, some pain points that they went through. But also the opportunity that happened immediately following. So now we are here a cycle later in the same spot, and maybe they're in a position and they've never owned before. But give me the 1, 2, 3 on why you would want to be an owner from a tax benefit perspective.
Yeah, you can write off your property taxes. You can write off your mortgage interest. And if you own the property as an investment, there's even additional write-offs. Everyone should obviously check with their individual CPA just because it's going to be more specific. But there's a lot of advantage in addition to you need a place to live. And if you're going to pay for a place to live, why not pay yourself and you own the property versus buying the landlord's property for them?
So if the mortgage payment is a little higher now because of the current interest rate environment, would you advise to refi at what point in the future? Like, give me the math on how much you want to see mortgage rates drop, because there are costs associated with a refinance. I know it's been a while since anyone's done a refinance.
I know. Yeah, we have to go back and
and I just don't know if anything's changed there, but you know, give me a case scenario with a certain product price point, and when, you know, Mary and Jerry are going to go ahead and say, this is the trigger point to refinance.
Yeah. It's going to be a little bit different with every scenario, but the rule of thumb is if the loan amount is under $500,000, if you can get a drop of 3/4 in rate, and or if you have mortgage insurance on that property, then it's more like 0.5% in rate. It makes sense to take a look at doing the refinance and run the cost benefit analysis. If the loan amount's over $500,000, typically the rule of thumb is 0.5% in interest rate. It makes sense to look at it, do that cost benefit analysis. And what I mean by that is look at the break even. We take what is the payment savings every month from doing that refinance look like against the cost to do the refinance. Anytime you do a mortgage loan, purchase, refinance, there's always third parties that have to be involved. Right. Appraiser, if that's required, title company, escrow company. Typical refinance closing costs are in the neighborhood of $2,000, $2,500.
Okay.
So let's just say you look at it and you can save that borrower $300 in their monthly payment. You divide that $300 into, you know, $2,500, and you're at about an 8-month break-even point.
Right.
So the question becomes, are they going to live in that house for at least another 8 months? And if the answer is yes, then that means they come out ahead by doing that refinance.
Okay, so we're talking about 50 basis points or 75 basis points is a needle mover for refinance. Yeah. Do you think that 2024 is the year we could see, you know, a typical mortgage rate come down 50 or 75 basis points?
I think it's very possible by the end of the year.
Okay.
Fannie Mae is a little bit more aggressive on their forecast than what I'm thinking that they're going to get to. Fannie Mae feels like we'll solidly be at 6% by the end of the year. I kind of am more in the camp of, I think, more like 6 1/4, maybe 6 3/8, but that would be phenomenal, because if you remember last year, there's a lot of people that were buying at 8. There was a lot of people that are in at 7.5.
They'll be refinancing.
They'll be refinancing, and with appreciation, that's the great thing about our market. There's a lot of appreciation. If they got in with PMI, in many cases, the appraised value of the property they purchased may have appreciated enough that the new loan they can drop the mortgage insurance off of.
I mean, let's unpack that for a second, because it's history is a great predictor of our future. And if we take, you know, Mary and Jerry homebuyer that did purchase in, you know, the last year when we know the market had corrected, and S&P Case-Shiller says median home prices are now rising everywhere. Yeah. So they might have seen, let's just say 5% appreciation, 10% appreciation in their home. That's very possible.
Yes.
But they did pay, you know, 8% mortgage. But they're now going to reassess the value of this home. They're going to refinance the mortgage, and that's going to look very good on the bottom line. Plus, they also got another tax year of benefits.
Yes.
Right. And they got the home they wanted, because, you know, part of becoming a homeowner is you still have to compete. So do you want to go out in a year from now when there's a lot of other competition and bidding, which is not a very fun process? Or would you rather go out before that, like now, when, you know, we're just starting to wake up, you know, tulips are pushing through the snow, and we know spring is coming, might already be here, actually.
Yes.
According to some of our agents who are seeing the loan originations, you know, really ticking up. But I just don't imagine waiting is going to make it a better experience for you.
No.
Because you're just missing out on time, and you can always refinance.
Yeah, you're better off to be that buyer that buys that house at $600,000 at a 7% interest rate versus the buyer that had to pay $650 at a 6% interest rate. You can always refinance the house. You can always refinance the loan. You can't renegotiate the purchase price that you paid for the house.
That's a forever benefit.
That's a forever. You're locking in your price. That's why, honestly, right now, rate doesn't even matter. I say to home buyers all the time, what you're looking for is to lock in your price. That's what's going to be with you forever.
Well, and hopefully, getting to a home you love,
Yes,
and being ready, and maybe that's an appetite for some of our consumers out there, that they know what they can qualify for, and when that right home comes around, they're ready to jump and be competitive, and or watch the market, because sometimes that is a lesson too, where the would have, could have, starts to ring in our minds, going, geez, we should have bought that Craftsman in Greenwood, or that waterfront home on Mercer Island. I mean, they're rare.
They're rare.
You have to be prepared.
Yes.
And I don't imagine, even with some of the turmoil that we've gone through in the metro area, in the city of Seattle, downtown specifically, and you were saying earlier, you see condominiums being a buy right now.
Absolutely. Yes.
But I'm noting that those are also bottom up. Those opportunities are becoming fewer and fewer below $800,000.
Yes. Yes.
So, be prepared, I guess, even if there's not a house for you right now, but get your affairs in order. And
absolutely.
How long is a pre-qualification letter good for?
So if it's a conventional loan, or it's good for 120 days. If it's an FHA, it's good for 90 days. But the great news about that is, if the borrower doesn't find a house in that time frame, we don't have to start from scratch. We just need to update it.
Okay.
So the loan officer they're working with should be in regular contact with them to see where they're at in the process, and just get the updated documents they need to keep it fresh. Because you're right, we have to pounce on those opportunities when they arrive. I feel our market is an inventory driven market, and more than anything else. And when that house comes on, you got to jump on it. Otherwise, it's going to be gone.
How else can we better prepare our first-time buyers? Let's talk about mom and dad, or grandma and grandpa, or the rich uncle. How much can family help you with the mortgage underwriting?
I think families would do themselves a lot of good if they jumped on their estate planning a lot earlier. Because if you want to help that younger generation with building their wealth and building wealth for a generation, there's a great saying that a state attorney friend told me. He said, the choice is either to give it to your next generation with a warm hand, or give it to the next generation with a cold hand.
I know where you're going.
And the point is, there's a lot of there are gifting. There's ways that parents can gift. There's ways that grandparents can gift, that are in accordance with tax rules, that are in accordance with estates, and things they can set up that allow them to help that next generation jump into that home. Because that is the thing about this first-time homebuyer generation. They're cash poor. They don't have a lot of cash.
And it's an expensive market.
Yes.
And you think it's an annuity for wealth generation, even wealth preservation for the family, to work through their children, to have them enjoy it, but also ride that equity gain, which is ultimately going to come to them anyways. I mean, certainly the warm hand, it feels better, and it's something that parents could enjoy. A couple of jokes come to mind, which is, so the wealthy parents say of their children, and say, all my kids, they're waiters, and they're in hospitality. Is that what you mean? No, they're waiters, like waiting for us to pass on. And the reality is that you don't have to wait for, your parents to benefit from their gifts if there's a way to structure. And I guess my specific question is, how much, just shy of them giving you all cash to buy the house, if you're in that fortunate situation, but can they co-sign on the mortgage, or can they grant a certain amount of money that is still a tax benefit to the parents?
It's all going to depend on what the parent situation is. And that's where they should get their CPA involved, as well as their estate attorney. But absolutely. So in many cases, you see parents that are co-signing for their kids on the mortgage to help them qualify, as well as to give them funds. You also have just basic gifting. I think that what's the gift limits this year? I think it's up to $18,000.
Yep.
So each parent could gift their child up to $18,000 if they want to do that. But to your point, the co-signing is another way that I've seen parents do that. And then what they'll do is they have, like, within the family estate plan, they have it written up to where when that time comes that the parent passes on, that interest goes back to the kid that they bought the property with. So there's a lot of really creative ways. And again, we don't have to have 20% down to buy. So even a 5% gift, 3% for down payment, it gets the kid in, and it lets the parent use it as a teaching mechanism
so important.
to watch them and teach it, watch them become homeowners and help them along the way, instead of the kid waiting until that ultimate day happens and then figuring it out on their own. It's just a different way. And obviously it's going to work best for some people, and there's things that it won't work for other people. But yeah.
How do you feel about where we're at in this economic climate of the city of Seattle and Bellevue metro area specifically? You know, we got an election coming up, without getting too political, unless you want to go there. I mean, what happens with the Fed and rates around an election? I mean, if you're trying to get elected again, what kind of environment do you want to see over the next 7 months?
Yeah, and that's a tough one for the Fed. I mean, I don't envy Jerome Powell. He's in a tough position because he really can't be influenced by politics. But if you're trying to get reelected, you want to see
Touch bottom and start coming up.
Rates going down.
Yeah.
You want to see rate cuts because it gives the perception that things are getting better. You want to see credit card debt come down. You want to see inflation come down. You want people to start feeling good about their budgets. Right now, people feel tapped out. Gas is really high. Every time they go to the grocery store, it hurts. It's painful. And they're reminded of where the economy is at right now. There's a lot of people that are hurting. There's a lot of people in financial duress. They could barely make their payments. They're not putting anything aside in an emergency fund, and their credit cards have skyrocketed. So what happens when we reach the limit where they've tapped out of the credit card and they can't finance this inflation on the credit card anymore? And that's going to be a little bit challenging.
You're running out of runway.
Yes.
And something's got to give. So what happens in, let's just say a new administration comes in? What is the reaction by the Fed then? I mean, I'm just trying to get a sense of how much stability do we expect for the months or quarters leading into a presidential election and the months or quarters that follow, typically. Typically
in an election year, we don't see a lot going on. It's sort of like do no harm. If you're looking for re-election, you're trying to do no harm. If you're the incumbent, if you're the person trying to beat the incumbent, you're just talking about how you're going to improve the lives of people. In this case, you could not have two more different approaches. And there's arguments on both sides to say there's some good in each, there's bad in each. But in an election year, typically we don't see a lot of movement. And the Fed doesn't want to inject themselves into an election and influence an election. Jerome Powell, I think, has made it really clear he's not going to be influenced, which I think is good. That will actually calm a lot of people down. But they're solely going to look at metrics. And I think the most important metrics is going to be where inflation is, where that inflation number is. Is it going in the right direction? The jobs numbers have been really skewed this year. If you notice, there's been a lot of where they've come out and readjusted them a couple months after. A lot of the new jobs being added are second jobs. That means people that have to get a second job to be able to make their payments in this economy. That's not a good thing. It's like they say, the devil's in the details. You'll get this jobs report that comes out that says, oh, we've added, this many jobs. This is great. But when you get to looking at it and you see that a big amount of it is either a government job or a second job, that's where you realize, oh, this number isn't so good. That's what the Fed is looking at. And that's where they're also saying, gosh, you've got Taylor Swift selling out shows all over the world. And in the United States, tickets on resale were going for thousands over what the price is. The Super Bowl, look at the Super Bowl this year. highest price tickets in, I think, history. When you have that much money being spent, our economy's still too hot. There's still too much money that's in the economy that has to burn off before the Fed's going to start cutting rates. When you cut rates, you're stimulating the economy. Doesn't need to be stimulated.
Do you feel like the price corrections that we've experienced in the last couple of years, in part because some of that demand was accelerated forward when we dealt with these record low interest rates? So that sort of gobbled up some of the future demand of home buyers. Like,
yes,
if I don't jump off now, I may never get in. And of course, prices skyrocketed. And then they had the inverse reaction and they started to correct. So it does feel like, prices have had that correction. But now prices are going back up again, and rates are coming down. I mean, are we going to see sort of hyper appreciation again in housing, or will we be able to have developers do their job and get us some more homes to buy?
My fear is I think it's going to be more competitive going forward. When rates start to come down, for every 1% drop in interest rate, 5 million more buyers are qualified to buy. I think as we drop an interest rate, it is going to cause the competition to be hot. It's going to be worse than it ever was, than we've experienced in the past. And the reason why? Simple math. There just isn't enough inventory that's coming on the market, at least in our area, that will be able to be gobbled up, that will able to be sustain the demand. The demand way overpowers what the supply
I mean, that's
is.
what all of our guests are saying, and we've spoken about, some of the measures like House Bill 1110, which is hopefully going to bring some infill housing, but probably way too little and take too long before it makes a difference. The high density neighborhoods are where they are, and developers are having a tough time financing their projects too. I mean, don't forget, construction debt is not inexpensive either. And these developers have PTSD from the experience they've just had over literally the worst conditions for home building that we've ever experienced, between the labor issues, the supply chain issues, obviously hyperinflation everywhere. Try to refinance any construction debt right now. Are you kidding me? I mean, and if you're in the commercial real estate market, whoa, I mean, they have to overqualify, because all the lenders are saying, look, I mean, your building's half empty. I'm not seeing that fill up anytime soon with this whole work from home or hybrid work week situation. So I just across the board sense that developers of all product types and price points are having a hard time getting any sticks in the air, and that is going to be a real challenge for us, and probably be record low inventory at a time that will have record high demand. And what's going to happen to pricing?
I think what's interesting, you what you brought up about these commercial buildings, that is where I think it's not being talked about enough. All these leases that are coming due out of our post-COVID era, where people haven't returned back to the office, where these companies don't need that much space, they're not renewing leases. We're now in that time where we're starting to see that all come to fruition. To your point, the commercial lenders are starting to tighten down on their guidelines, because they're saying, wait a second.
They don't want to hold the bag either.
They don't want to hold the bag. However, the opportunity in that is somebody or groups are going to see, they're going to figure out, how do we repurpose these buildings to where it is either it can be repurposed to residential. I'm not an expert in that area.
It's not happening. It's not happening.
Yeah, that's going to be an interesting one. If we see a way that somehow that can be, how that's going to end up flushing out, and what is going to happen to all that commercial space. How's it going to be repurposed?
Well, I just have the sense from you, Carese, that the water table is continuing to rise, and you need a life jacket to be in this game, and that's what the mortgage provides you. And there is a relationship between the rising value of your property that you own and the variable changes within the mortgage environment so that you can, tap into your equity gains that you're living in. I mean, I consider it a lifestyle investment because, hopefully you enjoy where you live and that it can be a great annuity with a lot of tax advantages. So if it feels like you're leaning in a little more than you wanted to, or you need a little help, from parents or any other temporary situation, like I'm going to go ahead and sell some stock, even though I don't want to, just know that you're on the bus heading the right direction.
Yes.
And when you want to cash out again, maybe you can defer some of your other decisions in your, your choice for lifestyle attractions, or maybe defer buying that car right now, or, maybe don't take the big trip. But jump into the market, get on the bus, and then what? Refinance or take a HELOC and make some of these other purchases?
Yeah, absolutely. I think that's exactly right. This is the best time. If you are a buyer, I don't see, with all of the metrics we're looking at, where prices are going down. They're doing nothing but going up, and it's just simple math.
Right.
So housing has to be the priority. And again, you can always refinance it. You'll get a break in your cash flow when you refinance, and then look to those other purchases that you're talking about. Kind of what I would call the just specialty fund purchases that you want to buy that aren't necessarily an appreciating asset that's part of your long-term plan. These are more of the just wants versus like the needs.
Well, that's great intel. Carese, give our audience a few other little nuggets that you would share either personally or professionally about, taking that step into home ownership. Something that you would tell, a loved one in a time like this.
Yeah, I think that it really comes down to where you have to look at relationship with money is an important thing. And that's where a lot of people, they don't feel like they have that path. So getting with people they know, let's say it's somebody in their family, let's say it's a financial advisor. It's really important, I think, in this day and age to look at what your long-term path is going to be with respect to like becoming a homeowner, getting yourself on the right track for investing, for saving money. One simple thing that people can do that would help themselves, especially if they want to be a home buyer, instead of putting their money into a retail savings account that earns 0.25%, go put it in a high yield savings account. That will help them. Right now, you can get those yielding 5%.
Wow, that's shocking.
That can help. That can help them get to that down payment amount quicker and quicker. It's always important to have your money work harder for you than you did for it. So getting going on that, looking at that investing, even if your homeowner's dreams are 4 or 5 years down the road, that's okay.
Be on the path.
Let's get on the path. Let's really examine your relationship with your money, make sure you're investing and you're spending based on what your values are and what your goals are, and get the money out of the retail savings bank. Go get it in a high yield savings account, at least. Then from there, you can go and invest.
Well, you're a great talent, an excellent lender, and Movement Mortgage is an originator you can feel good about working with the charitable donations that you guys are making with the foundation. So thank you for that.
Yes.
And I have this vision in my head of you spinning around on the ice. How is it that you never get dizzy when you're doing those high spins?
Yeah.
Do you focus on like one thing constantly, or do you just close your eyes and hope you don't fall?
Yeah, I think skating specifically, the way the blade is shaped, you have to find that place on the blade, and that puts your body in balance, and your ears actually adapt. And so no, you don't spot. Like in dance you spot, skating you can't spot. So you just learn it through the muscle memory where you're at in that spin or where you're at in that jump. But it really is it's that place on the blade where you have to know, you learn where to find that, where your body is completely balanced. And that's really how you do it. And you don't get dizzy, actually.
And hopefully that's like our economy and the soft landing that we all want here with the Fed is the path that we're on. So, Carese, always so fun to have you.
Always so
and
fun.
You have a wealth of information. And join us next time for another edition of Market Perspectives. I'm Dean Jones, your host. Thank you, Carese Busby with Movement Mortgage. Be sure to follow us on social media and share a comment. And we will see you next time.